If you missed just the 10 best days in the stock market over the last 20 years, your returns would be cut nearly in half. Not 10 months, not 10 years, 10 days. So let me ask you something. Are you trying to be smart? Or are you trying to be rich? Today we're breaking down the brutal battle, time in the market versus timing the market. And one of them quietly destroys portfolios. You've felt it before. Market crashes. Headline screaming recession. Your portfolio bleeding red. Your brain says, get out, protect yourself, wait until things feel safe. That's timing the market. It feels intelligent. It feels proactive. It feels responsible. It's also where most wealth dies. Let's define this clearly. Timing the market means trying to predict when to buy low and sell high. You wait for dips. You sell before crashes. You jump back in at what you believe is the right time. It sounds logical? Now, time in the market means you invest consistently and stay invested long term. You ignore noise. You don't predict. You let compounding do the heavy lifting. Boring? Yes. Powerful? Unbelievably. Let's talk numbers. If you invested in the S&P 500 and stayed fully invested for 20 years, you'd average around 9 to 10% annually. But if you miss the 10 best days, your returns drop dramatically. Miss the 20 best days, and it gets worse. Here's the twist. Most of the best days happen right after the worst days. Which means if you panic sell during crashes, you almost guarantee missing the rebound. Timing doesn't just fail. It sabotages you. Timing sounds smart because it feeds your ego. It makes you feel in control. But markets don't reward control. They reward patience. Timing requires you to be right twice. When to exit and when to re-enter. Professionals struggle with this. Hedge funds struggle with this. What makes us think we'll nail it consistently? Let's rewind to 2020. The pandemic hits. Markets crash 30% in weeks. Fear everywhere. Millions sold. Then what happened? One of the fastest recoveries in history. The people who sold to be safe locked in losses. The people who stayed rode the rebound. The difference wasn't intelligence. It was discipline. But wait, does this mean timing never works? Not exactly. Some people get lucky. Some traders outperform. But here's the uncomfortable truth. If timing worked reliably, index funds wouldn't dominate. Passive investing wouldn't win. Yet most active fund managers fail to beat the market long term. That's not opinion. That's data. Time in the market unlocks something timing cannot. Compounding. Compounding is not linear. It's exponential. In the early years, growth feels slow. Later, it accelerates dramatically. If you keep pulling money out trying to dodge volatility, you interrupt compounding. And small interruptions early can cost millions later. Here's what nobody tells beginners. Volatility is the price of admission. You don't get long-term gains without short-term pain. If you want 8 to 10% annual returns, you must accept drawdowns. Trying to remove volatility usually removes returns. Market timing is often just disguised fear. Now let's be fair. Timing can make sense in specific cases. Tactical asset allocation, risk management, near retirement, short-term trading strategies. But notice something. Those are systems, not emotions. Most people aren't using structured strategies. They're reacting to headlines. And that's dangerous. The debate isn't which one is smarter. The real question is which one fits human psychology. Because the best strategy is the one you can stick with. And most people cannot consistently time entries and exits. But they can automate investments. They can dollar cost average. They can stay invested. Think of investing like planting a tree. Timing the market is digging it up every time clouds appear. Time in the market is letting roots grow through seasons. Storms will come, but so will sunlight. And growth requires both. So here's the uncomfortable truth. Timing the market makes you feel smart. Time in the market makes you wealthy. One feeds your ego. The other feeds your future. Choose carefully, because missing just a few days can cost you decades.